So today, as Allison noted, I'm going to be talking about reporting, disclosure, and documentation, best practices, as well as just sort of a reminder and refresher about a lot of those basic requirements. Okay, we have a poll, and let's see what the choices are, what people elect, because it's a little bit of a trick question. All right, so how often must a plan summary, plan description be updated? Annually, every 5 years, every 10 years, or never? Okay, we're still looking at a few more participants. Okay, we'll stop here. So I think every 5 years is probably the most common situation for most plan sponsors. So while that is a right answer, there can be other right answers. Every 10 years is an outside limit on distribution of SPDs, but that's really for plans that haven't had any amendments. Kind of almost hard to imagine a plan without amendments. So 5 years would be a good default. And then, of course, there could be interim SMMs. And often we see interim distributions of SPDs when there's just either several amendments at once or other reasons that make it just valuable or easier to update the SPD. All right. Hold on. Another poll. All right, true or false? A Form 5500 must be filed each plan year for every plan. Give it just a couple more seconds. Okay, this is also kind of a tricky question, and I give credit to the person who created these poll questions. It was not me. So there's a little subtlety here. The general answer is, yes, the 5500s have to be filed every year, but not for every plan. There are certain exceptions for fully insured small plans, certain type of plans that really may seem like an ERISA plan, but aren't ERISA plans. So there can be exceptions to that rule. And we will touch briefly on some of those exceptions. All right, so in line with ERISA's birthday and some of the history that Bryden outlined, reporting and disclosure is a very key and fundamental purpose of ERISA. And I think it's really important to keep that in mind. That's the why. That is the reason for all of these voluminous requirements. It's, to enable employees to be informed so they're not in the dark about their benefits. It's was stated in, legislative history at the time ERISA was adopted. And it's both financial information and other information that enables people to understand their benefits. So employees and participants are the heart of the disclosure requirements, as we'll see as we go on. And as I mentioned, it's a why, so it's maybe something that could make you feel slightly better about all your responsibilities here, but it also is something that may allow you to realize that an unusual or a non-recurring event could prompt a disclosure requirement or a plan amendment. So something that is not an annual requirement and maybe something that happens only once in the life cycle of the plan could have a reporting responsibility. The Internal Revenue Code is a source of reporting requirements as well as ERISA. There can be PBGC requirements, of course, for defined benefit pension plans and money purchase plans. And the plan documentation requirement is also something that is, I think, in line with reporting and disclosure, although it's not something that, is filed absent of filing for a determination letter. It's a part of the paper and the methods by which participants can understand their benefits. And also, it's a way to ensure that the plan sponsor, the employer understands what they're supposed to be doing, as has been alluded to in some of the earlier slides. As far as plan documentation, especially for a qualified retirement plan, a definite written program has to be communicated to participants. So there are many IRC requirements, but there are also many type of benefit description provisions that have to be stated in the plan. They can't be cross-referenced. They can't be implied or done just by operation. They have to appear in the plan. Benefits have to be determinable. That's pretty obvious for a 401k plan, but certainly for other types of plans, it's important that the formula is clear. And your actuaries, your advisors, your lawyers help employers get that right, but it is something that is required by the Internal Revenue Code for qualification. And along those lines is a definite predetermined formula for calculating benefits. So why is this important to plan sponsors? Well, as just mentioned, it's key to qualified plan status. So it's just part and parcel with maintaining a qualified retirement plan to get that documentation right. Disclosure requirements, reporting requirements to be adhered to help plan sponsors avoid penalties. Again, seems obvious, but penalties have increased in recent years. So it's really something that is not just a pain if you discover there's a mistake and you have to go through the time to correct it, but there's a cost. It's always good to, again, with some of the less common requirements, to have a method for both in advance and just sort of checking yourself, because if there was something that was missed or an error, correcting as quickly as possible almost always make sure that, helps you ensure that penalties are as reduced as possible. ERISA's purpose, that's not only does it help participants just simply understand their benefits, but it helps you communicate what you're offering to participants. Most plan sponsors are, doing their best to give a wide scope of non-cash benefits to their valued employees. And it's just something that is, it should be a positive. And so your communications can enhance that. The documents, your documentation requirements help enhance proper operation. It's also important just a little bit, defensively, or maybe even, I guess I would say proactively. It helps you be prepared in advance of transactions, significant investments, other corporate events. Employers who go through something like that are going to be required to establish that they've been in compliance with ERISA and the code, and sort of an orderly process and regular attention to these requirements helps you be ready to go if that were to occur. Similarly, preparation in advance of an audit, either, just sort of an annual audit internally or, an external audit, governmental audit being prepared. And then finally, and along those lines, just mitigating litigation risk. COBRA notice litigation is something that I was discussing this with Brian the other day. He mentioned there's a lot of attention to detail by people whose main job for the day is to find a way to sue an employer. So to try to be proactive as best as possible with all requirements can really you know, get you best prepared to deal with anything like that. Okay. Another thing to think about that I guess is somewhat of a best practice, but is just part of the process is who is responsible for filings, amendments, and distributing communications when outside service providers are involved. And, even though ultimately the employer has this responsibility as plan sponsor, who contractually is responsible? And this isn't it's your job, it wasn't my job, not that type of thing, but just clarity so that all parties can efficiently and, focus on what they need to do and not have duplication of efforts and not have anything dropped inadvertently. So this is especially true when you're switching, perhaps switching a prototype plan document, switching brokers, insurers, any type of service providers, just to make sure that everybody, is on the same page. Another question you may want to ask is, how do your internal systems enhance compliance? So, what can you automate? What can you calendar? Who internally is responsible? Is there a way to break out between types of plans? Because, welfare plans alone have voluminous notice requirements. If there is really what I would say is a luxury to focus on one category of plan, that's great. But if not, just, either an individual or a team really try to identify the scope of what could occur annually or, on an event basis and really divide and conquer. Let's talk briefly about plan categories because, many requirements apply to all plans, but actually most do not apply to all plans. So just thinking about what basic category different types of plans you may maintain fall into. So qualified retirement plans, so obviously that's 401k plans, that's pension plans. ESOPs or ESOP components of a plan, those are defined contribution plans. And ESOPs have, a number of additional or sort of quirky requirements. Cash balance plans are a type of defined benefit plan. As I mentioned before, money purchase pension plans can have defined benefit plan like requirements in some cases. 403B plans, those are defined contribution plans. So there's a wide variety of requirements that may not apply to all retirement plans. Welfare plans, you have health, life, disability, dental, vision, are those group health plans? That's completely beyond the scope of this presentation, but what has to be provided based on the type of welfare plan you have. A severance plan, is that even an ERISA plan? Individual agreements providing severance, is that an ERISA plan? I mean, in many cases, no, but it's important if you do have severance benefits, either across the board or for certain employees at your organization, to understand the status of those plans. Section 125 plans, those, and I may not be stating this exactly right, but think about your cash and qualified benefit election, your 125 plan, as related to or adjacent to your welfare plans. It's not a welfare plan, but it is a plan that requires documentation and that requires the same level of attention in terms of that document as some other plans. Non-qualified plans, these might be referred to as SERPs. They might be referred to as executive deferral plans, non-qualified deferred compensation plans. Certain deferred incentive arrangements. Is your non-qualified plan a is it an ERISA plan? And generally it is an ERISA plan if it is a pension plan. And that, again, we could spend about 3 slides on that, but a lot of incentive arrangements that I see sometimes add a retirement component and a retirement distribution component, which a lot of times gives us pause as to whether, gosh, we need to think about filing a top hat or making a top hat filing because indeed there is a retirement component to the plan. So there's just a little bit more to think about in terms of what is required if you have an unusual non-qualified plan. The same thing with directors. If you have a plan that is exclusively for non-employed directors, no one who's an employee could participate. That's, the directors are not employees under ERISA, but there are numerous other requirements that would apply. Governmental and certain religious entity employers are not subject to ERISA. With religious entity employers, I think it's very important to understand that status because it's not just, many organizations are not simply a church. They may be church or religious affiliated, and there's some nuance there in determining what rules apply. However, all those entities may still have IRS and other sources of reporting, disclosure, and documentation requirements. Here's some things that I guess are potential pitfalls or just areas to think about in terms of, again, just a little bit more, there's more than one answer type points. So is a 5,500 required, and if so, which form? Voluntary benefits are something that there is an opportunity to offer without those benefits being ERISA plans, but the level of employer involvement, even sort of inadvertent or just trying to be nice, can move you more into ERISA welfare status. So that is something to, essentially we're happy to help you walk through that for anyone who has a voluntary benefit program that they're uncertain about. 100 participant rule. Are you counting participants properly if you're trying or believe that you qualify for either an exception or a different, shorter form version of the 5,500 series? So making sure that counting is done properly. PBGC reportable events for defined benefit plans. These are, they are less common events. They don't all relate to funded status of a plan, but often that is associated with a reportable event that, that could be covered. There are some advanced reporting requirements under this PBGC scheme. Others are, post event or transaction, but if you have a defined benefit plan, it's important to really just become aware of what those reportable events could be, and then you might be able to say, these just do not apply, or there's something to keep on your radar. 60-day advance notice of group health plan changes. So this is something that again, for detailed analysis here, Bryden is the one to talk with, but it's something that could perhaps be impracticable in the context of a transaction, but it is a requirement, and this is not an SPD requirement. This is a advanced notice for not just a material negative change, but a change in a group health plan offering. 401k safe harbor mid-year changes. There are notices that have to be provided. A sort of more fundamental point there is with the safe harbor plan, are you trying to make a change that is indeed permitted? Are you in a transaction situation where more likely you would be able to make such a change? But both for those notices, think in advance of the desired change date, because, you know, a notice, if the change is permitted, is very likely to be required in advance. Okay, we mentioned this before, or I mentioned it just when describing the cafeteria plan, but there's a written plan document requirement. It's an advance requirement before elections are made. Changes are to be prospective. And so this is something that is, you know, it's a tax requirement, and it feels very technical sometimes, because there are processes that are complicated enough in terms of, you know, ensuring benefits are communicated to participants like true benefit offerings, ensuring that everyone has an opportunity to make elections. And this, you know, I'm thinking about, say, in a transaction context, or just, you know, other changes. The focus might not be on a signed, written, text-driven plan document, when really you're focused on SPDs and insurance policies, but it's just something that's very important to observe it in the welfare benefit category, even though it's not a welfare benefit plan itself. SPDs versus plan documents. It's great to state in your SPD that the SPD is a summary only and defers to the plan document. I mean, that's the law, the plan controls. However, both to, you know, the purpose of an SPD is to be a summary, it's to be understandable. So there will be fewer words, one hopes, in an SPD than in a plan document. And so it's just important to communicate like the order of authority, essentially. And all of this is just designed, this is both to help the employer in terms of, you know, a challenge or a misunderstanding about benefits or a claim, but it's also just to help the employee to, you know, they have the opportunity to ask for the plan document if they really want it. And, you know, so this is just something to keep in mind in terms of descriptions. And then plan document versus plan operation. Also, the plan document controls. I think we all know this, but to reiterate, understanding what your plan document says, following the plan document, and if the plan document is obscure and, you know, your lawyer had said, no, that language is perfect, it's fine. And it may be the exact proper way to phrase a particular section in terms of IRS guidance. But if there's a misunderstanding in whether implementation lines up with the plan, just, you know, check in with your service provider. Okay, so we're going to talk about, and these really are in no particular order, but I have, I've identified at the beginning of each of these event-driven requirements and obligations, the general type of plan to which it applies. And I guess one thing that I want to just bring to your attention, and I didn't link them. Anyone, please feel free to email me if you're interested. But I find, because this is something that I, you know, have done for a really long time, but I also, my focus is not, you know, this is not what I do or have to do every single day. So there are things that I remember and know, but gosh, I want to check. Is it 60 days? Is it 90 days? Is it advanced? Is there something new? I found that the IRS, DOL, and even PBGC, some of their guidance, and not really, I guess what I'm referring to is there's some really good charts that are not out of date. They may be a couple years old, but they're very clear and comprehensive government sources. So it's not like you're reading the regs, but you're able to see it straight from the governmental source. So those are some useful resources. and you can eyeball it fairly easily. And I'm happy if anyone wants to reach out after the presentation. At any time, we can provide those, as well as, of course, answer specific questions. But here's some selected event-driven requirements, not necessarily getting into the 5,500 and other annual requirements right here. So plan mergers, plan spinoffs. There are forms that are filed with the IRS in advance. So this is a, hey, get your ducks in a row. Certainly any plan merger or spinoff is something that is going to be planned well in advance, but there are some filing requirements. Exceptions can apply for defined contribution plans and may often apply for defined contribution plans, but it's something just to keep in mind that really is, it's just extra. You're going to be amending the plan. You're going to be communicating. You're going to be having board meetings. You're going to be updating your SPDs. But this is just something else that is part of that process. For DB plans, consider the applicability of PBGC requirements. Reportable events that I mentioned, they can be pre or post event. And there are exceptions, and many of these requirements apply to underfunded plans, but it's just something whenever you're making a change, again, would a participant want to know this? Would the governmental authority want to know this? This is a change. I better check my requirements. So it's just a reminder to do that. If you're terminating a DB plan, that's a huge process. But some of the termination notices I'm just going to run through. There's an advance notice of intent to terminate. There's a notice of plan benefits. You're going to be doing much of this as part of your employee communications and really advanced planning, certainly with your actuaries, but gosh. Okay, sorry. Too enthusiastic about this. Yeah, it's a particular notice, a standard termination notice, notice of annuity information, notice of annuity contract, a 204 distribution notices. Of course, those are normal. 204H notices when benefits are going to cease being accrued. There are a lot of things that are in parallel to your very substantive and financial planning that goes into a DB plan termination. Application for a determination letter. There's a notice to interested persons. And, even though determination letters are not as regularly sought as they were when there was just sort of the regular filing cycle, there are a lot of instances in which that process is still available to employers. So it's just important to keep in mind the advanced notice. DC fund changes, I think we're all aware of this, 30 to 90 days in advance. Non-qualified plans, as I mentioned, once you sort of identify the universe of your non-qualified plans, or if something new is being adopted, or an individual agreement being entered into with an executive, once there's a determination that, yes, this is indeed an ERISA pension plan, even though it's, for a very narrow group of people, there's a top hat filing. This is to be filed 120 days after the plan becomes subject to ERISA. It's online, it's free, it's very easy, but it is something that does need to be done. After the plan becomes subject to ERISA, generally that's going to be, the later of adoption or the effective date. That's the implication. I think, you don't want to, ideally, you're not going to adopt something with a January effective date in December. Completely different world, because we have 409A, IRC section 409A tax requirements that you have to think about as opposed to qualified plan requirements. But anyway, that's a nuance. And I guess just another thing for non-qualified plans, apart from ERISA, but any deferred compensation arrangement, and this would include director arrangements, individual agreements that you determine are not retirement-based, but they are deferred compensation where you promise this year to pay something in a future year. Those have to be documented in writing to satisfy tax requirements. So, just another angle there. Material plan amendments, plan terminations, discretionary amendments, required amendments. These have to be documented. They have to be documented within time periods that vary based on the nature of the agreement being entered into, not agreement, but amendment being entered into. So that's just something to keep in mind. There are a lot of different deadlines there. We're going to go through some of these fairly quickly, just because they're detailed and they are not annually applicable. Blackout notices, like at 125 plan, adoption of a written 403B plan. That means there has to be a plan document. 404C disclosures, those are disclosures that can provide an employer with, I'm sure most of you are familiar with, some protection from individual investment choices, provided that the investment choices have been selected through prudent practice. QDIA notices, these they might occur on new enrollment. It could be connected to a rollover or sort of an unusual plan change that is happening where a QDIA would be relevant. Tax distribution notices, people are very familiar with that. I'm gonna go through some of these a little bit quickly. Yeah, a QIPSA notice. This is very, for anyone with a defined contribution plan with a surviving spouse automatic pre-retirement survivor annuity, a window when participants turn 32 or enrollment after age 35. That very narrow and specific, but something that if you have a defined benefit plan to be aware of. Self-corrections, we recommend, so a self-correction, sort of by definition, may not involve a filing. However, documentation of the process that has been used to make that correction and contemporaneous is really, essential. It both helps you make sure that you've touched all the bases for the self-correction. It provides something that you have in the event of an audit, or if somebody's, again, diligence in the event of a transaction. But, part of the correction process is the documentation. Quadros, qualified domestic relations orders, generally on receipt and then within a reasonable period of time after determinations, notice of a determination that the item is qualified. All of those are reasonable within a reasonable time period, but keep it quick on those, because those really high stakes to the people involved. I think because of time, a lot of these just can be a resource for folks, the very specific event-driven requirements. But let's go to some recent developments. So for lump sum windows, effective after the DOL issues final regulations, so not now, but be alert, there's going to be some advanced disclosures. There's certainly, there are many steps currently involved and required by the code, just because it's a plan amendment. there's communication. But there will be, after final regulations come out, just more information reporting and advanced disclosure to be aware of. Working with your service providers, your actuaries, obviously that's a given. Annual funding notices for plan years beginning after the end of 23. This is for DB plans. There just have been some changes to the annual funding notices. The No Surprises Act, surprise billing. Generally, that's going to be a carrier or TPA responsibility, but if you have any questions, please reach out to us or reach out to Bryden. And Form 5500 changes. There have been some changes, participant counting methodology. People might be familiar with that. That's kind of a more recognized change. And then there has been a deferral of some participant employer information reporting relating to MEWAs. So I think that's it. And thanks to everyone again.